Hi, Charles Sizemore here. And for this week's Dividend Stock of the Week, we're going to revisit an old friend. I've always been a fan of mortgage REITs under the right conditions. I should put a big caveat there. The beauty of a mortgage REIT is that it's one of the most highest yielding stocks you're ever going to find. The downside to that, of course, is that your total return is almost exclusively the yield. These are not stocks that you're going to build this long-term capital gain in, because they're not designed for that. They're essentially, I can't call them hedge funds, but they're basically like a hedge fund. They borrow money and they redeploy it into higher yielding securities and make money on that spread. They borrow cheaply. They lend it out in higher yielding mortgage securities. And again, that spread in the middle there, that's what you get. But that's a recipe for high current income. It's not a recipe for long-term capital gains. So when you buy mortgage REITs, the only way you're going to get capital gains in them is if you're very careful when you enter the position, when you exit. If you buy them when they're on sale and you sell them when they're sort of looking stretched, you can eke out a capital gain there, but that's it. These things are for current income and for trading. Unlike equity REITs, which buy physical properties, they're really not designed for long-term wealth building. But that's okay. In this market right now, I think we do need to be a bit more tactical, and I think there's nothing wrong with looking for sort of a short-term trade that pays you well while you wait. And so with that as an intro, let me introduce you to Starwood Property Trust, ticker symbol STWD. Now, mortgage REITs really got their heads caved in last year. They had margin calls. And if you've ever experienced a margin call or know someone who has, the just living hell that is. You have positions that may be solid, they may be perfectly fine positions, but because of some short-term market move, they are depressed. Well, if you bought them on margin, if you levered up to buy these, if you borrowed money to buy them, then you have a problem. The bank tells you, or the broker tells you, you got to pay back the loan. You got to pay it back right now. You can't wait for the market to stay rational or get rational. And as Lord Keynes said, the market can stay irrational longer than you can stay solvent. And that's what happens here. The brokers have to protect their balance sheet. And so if your loan is bigger than the value of the asset supporting it, they just liquidate your account. And that's what happened, or they make you bring in capital from outside. Well, that's what happened to the mortgage REITs. Last year, when the capital markets seized up in the early weeks of the coronavirus crisis, there was no market. These mortgage REITs had these mortgage assets, which in some cases were Fannie Mae and Freddie Mac bonds. They had these assets, and there was no market for them. So the price was effectively zero. I mean, it wasn't quite zero, but it may as well have been. And so these mortgage REITs were in the really nasty position of having to liquidate their assets at fire sale prices in order to pay back these loans. That resulted in permanent capital loss for some of these. If you want to see what true destruction of a portfolio looks like, check out the Invesco mortgage REIT, ticker symbol IVR, I, V as in Victor, R. Look at what happened to that stock. Pre-COVID, the thing was trading at about $16 a share. Today, it trades for about $3, and it's not coming back. There's no way this stock will ever recoup those losses, because the value was destroyed. It was a permanent loss. They sold their assets at fire sale prices and liquidated the portfolio to pay back the loans. There's no getting that back. If you buy, let's just make something up. You buy Microsoft stock and they bomb out their earnings and the stock drops. If you hold on to it long enough, it could make back those gains and go on to new things. If you bought Microsoft at the peak of the dot-com bubble back in 2000. Sure, it dropped, but if you held on to it, it came back. Well, you're never going to have something like that with some of these mortgage REITs that got blown up because the capital was destroyed. You might as well set them on fire and watch them burn. It's gone. It's gone. It's not a matter of price. It's a matter of destruction of capital. And so I'm proud to say Starwood avoided that. Starwood managed to avoid the just utter destruction of its balance sheet by margin calls. Now, that doesn't mean the stock didn't take its lumps. This was a $25 stock pre-COVID. Before all was said and done, the thing had dropped down into the sevens. It went from 25 to $7 and some change. Now it's trading kind of back where it was pre-COVID. It's basically recouped those losses. But I'm happy to say it's, while the rest of the market has blown long past its pre-COVID levels, Starwood is basically back where it was pre-COVID. It's like, it's over. The pandemic happened. It's over and we're back where we started, but we're at a reasonable valuation. We're not, 20% higher than pre-pandemic, which is where, or more, which is where a lot of the market is right now. So kind of to give some background here, what is Starwood and why is it different from some of these other mortgage REITs? Well, to start, it's a hybrid. It doesn't just own mortgage REITs that it has levered to the hilt. It also has real property. It has a portfolio of actual tangible assets, and it makes commercial loans. So this is not just a levered up, mortgage hedge fund, which is, again, essentially what a lot of mortgage REITs are. This is more of an operating business that also has a large loan business attached to it. So that gave it a little bit more, tangibility, if that's the right word for it, but it enabled it to get through the pandemic in one piece. It had higher quality collateral. When the pandemic was in its early stages, nobody wanted mortgage paper. That was considered, it was essentially worthless collateral. Starwood had collateral that was more valuable and did not result in margin calls. So, why do I like this now? Well, I liked it better a year ago. A year ago, these shares were the buy opportunity of a lifetime. You will probably never see a buying opportunity in these shares like we did last March, last April. But that's okay. They're still reasonably priced. And in this market, we're just looking for anything that's not expensive at this point. Real true bargains are really hard to find right now. I'm happy if I find something that's just fairly priced, not overpriced, if you will. And this stock certainly fits the bill there. It does sport a very competitive yield, 7.3%. You're really not likely to find a yield better than that too many places. You can in some pipeline stocks, you can find in some other mortgage REITs. Higher yields do exist, but not many of them, and generally not as high a quality company as Starwood. So if you are looking for a safe, steady, kind of conservative 7.3%, then this is a stock you could really look at. So the drill. We always like to look at every stock we recommend through the lens of our green zone rating system. This is Adam's project here. It gives us a very objective lens to look at every stock we recommend. I can be a bit emotional at times. We all can. We're human. We can get attached to our stocks. But just remember, when you love a stock, it will never love you back. It's a tease like that. So having our objective green zone rating system here that helps us to keep those emotions in check. If a stock really has to pass the grade here, or it's not really one we consider. So with that said, the stock definitely does make the grade. It sports an overall rating of 63, which puts it in bullish territory. Now, the stock has sort of fluctuated over the last couple of days. It's been sort of in the high 50s, low 60s. That's sort of kind of bouncing between neutral and bullish, but it's on kind of the bullish side of neutral, if you will. I'm very comfortable with that for a long-term income holding. And this is one of the few mortgage REITs. Earlier I said mortgage REITs are not long-term holdings. This is one of the few that I would say is, and it comes down to its property portfolio. In addition to its vibrant lending business, it also has that tangible asset portfolio, which makes it different. It's not a pure mortgage REIT. It's a hybrid. So I just talked myself in a circle. I don't know what I was saying. So where does that leave us? So for a high yielding income stock like this, I'm very comfortable with an overall green zone rating of 63. Now let's drill down into kind of the constituent parts to see where it kind of adds value and where some of its weaknesses might be. To start, it rates really high on momentum with an 87. And 87 out of 100. Only 13% of the stocks in our universe rate higher on momentum. That's pretty easy to understand if you look at the last year. I mean, the stock bottomed out at $7 and some change and then rallied to 26. That's some serious momentum over the last year. Now, that momentum is not going to carry forward indefinitely. I do think the stock has some upside left in the price. Apart from the yield, I do think it has some upside, perhaps 5 to 10% from here. But you are not looking, 5 to 10% in relatively short order and then slower gains over time. But you're not looking at, the kind of, rip your face off momentum we've seen over the last year. That's not going to continue. That was a snapback. The price got irrationally low and it snapped back to pre-COVID levels. So that momentum score, while very high today, and I'm very excited to see that, that will start to flag over time. Over the next few weeks and months, I would expect that to come down a little bit. But for now, the stock definitely does have some momentum behind it. Volatility, it also rates really well. Volatility, it rates a 75. That's solid. Pre-COVID, this was really not a stock that moved much. It was a conservative income play, and it just didn't move. It was stable. COVID upset the apple cart, of course, but now that that's mostly over, I think that high volatility rating, which means a high volatility rating means low volatility, I think that's actually likely to go higher. So this is a good low vol stock, pays good dividend. It's ideal for a dividend payer. You want your dividend payers to be slow and steady. It's the tortoise that beats the hare, and it certainly makes a grade on that. Moving on, despite the fact that it is a low vol stock, this actually does rate pretty well on growth. It rates a 67. That's solid. So we are getting growth in this business. Apart from the income, there is a growth component. That's good. Value, it's also no slouch. The stock is not dirt cheap. It's sort of middle of the pack. It rates a 57 based on value. But again, we're not necessarily looking for cheap stocks in this market because they're exceptionally hard to find. We're just looking for fairly priced stocks right now. And this stock I consider to be very fairly priced, and its value rating, 57, reflects that. This is a sort of a middle of the pack valuation, and that's okay. Moving on, quality, it does suffer a little bit on the quality rating. It only rates a 36. That's not too surprising because of the accounting of REITs. It really gets zinged by two things. One, REITs do have high levels of debt. It's just part of the business. It's normal for anything backed by real estate to have high levels of debt. But that it takes points off of the quality score. It is what it is. It's just a function of the quality score. High debt means low quality, the way we calculate it. You also have some of the quirky REIT accounting where you have non-cash expenses like depreciation and whatnot. All of that is to say that while it doesn't rate really high on quality, I don't consider that a deal breaker, particularly for a REIT, because we expect it. We expect REITs to generally rate low on quality because of the way the numbers work out. And we understand that going into it. And then finally, size. Starwood's not huge. It's not a mega cap by any stretch, but it's not small. Market cap $7 billion. So it rates a 17 on size. That's low, which means it's the larger the stock, the lower the rating on size. It's no big deal. It means we're not likely to get a small cap bounce, but that's okay. Overall, that's not a deal breaker by any stretch. So what do we get? Kind of review here. Starwood is a solid mortgage REIT, or mortgage hybrid REIT, I should say. It got through the COVID pandemic with its assets intact, with its balance sheet intact, importantly with its dividend intact. It never had to cut its dividend. A lot of its peers did. So this is very much a survivor stock that got through the Armageddon in one piece. So it rates well. It has a great dividend, 7.3%. If you are looking to build out an income portfolio, this is certainly a worthy contender for a slot. So that's it for this week. We'll pick this up next week.